Hey traders, today we're going to talk about the concept of smart money in the financial markets. You may have heard this term before, but what does it really mean and how can it be useful for traders like us? In simple terms, smart money refers to large institutional investors or professional traders who are thought to have access to more information and resources than retail traders. These more money players are often assumed to be more sophisticated and better able to make informed trades based on their access to inside information and analysis. Now, as retail traders, we may not have the same level of access to information and resources as more money players, but that doesn't mean we can't still use their activity to inform our own trades. By observing the trades and positions of smart money players, we can potentially get a sense of which direction the market is heading and make more informed trading decisions. One way to do this is by using technical analysis tools like equal highs and lows, trend lines, and inducements. These tools can help us identify key levels of support and resistance, identify trends, and make more informed trading decisions. Alright, with that being said, let's go to the chart. Alright, so imagine this is a chart. So we have a higher high, higher low, higher high, higher low, higher high, and again a low over here that's equal to the previous low here. So what retail traders would say is that this is a double bottom, and they will most likely enter a trade from this area over here. So they place their order. Let's make this a bit smaller. They'll place the order like this, stop loss just below the low, and then target the high over here. This is what retail traders would do. But what we've seen in the past in backtesting the smart money concepts strategy is that these are areas where liquidity is laying below. So what we tend to see is that price bashes through the stop loss of the retail traders and goes to the extreme order block over here. So what we have learned in the previous episodes of the Smart Money Mastery learning videos that we've made so far is that we have a break of structure. Let's identify it like that. I have to make it the top one. So we have that happening here and here. So we will have an order block that's down here. And let's say this is the swing low and this is the swing high point. So now we're taking into consideration the premium and discount zones, because we can trade from every break of structure that we can see, and we will maybe get a percentages. But if we would go only for the extreme order blocks, maybe you will get less trades, but they are way more accurate and less riskful. And we rather be conservative than aggressive. So of course we could trade like the retail traders with this double bottom, because it would perfectly trigger the order block over here. But we're going to be a bit more conservative and take in consideration that this is an equal low and that this is an area where retail traders would like to get into. So this is an area of liquidity that needs to be cleared, and we will enter from the extreme order block. So if we would draw the premium discount zone from swing low to swing high, so swing low to swing high. This is the premium zone, this is the discount zone, and this is the zone where we would like to get our entry in. So we place our limit order on either the equilibrium or on the high of the order block, and we place our stop loss just below the low and then target the high, and you will see that our entry is more accurate than the one from the retail traders. Hopefully this will make it a bit more clear. I will come up with a live example later that I've taken personally myself. And it's just like important to know these concepts so you won't be induced to enter from an order block from this area, or perhaps one higher, or maybe another one higher, because you will lose money at the end of the day. So we rather stay conservative than aggressive. Alright, so we've just talked about the equal highs and equal lows concept. There's also trend line liquidity concept. So what this is that retail traders like to trade on trend lines, and most of the time they would enter on the third touch of a trend line. So we have a clear trend going up here. So with the higher high, higher low, higher high, higher low, higher high, higher low, higher high. And then this will be the third higher low, and this is where people will enter on. That will be their confirmation. So they would enter on this area over here, and then target the high, place their stops just below the trend line, and then they would trade and pray to God or something that they would make some profit out of here. And sometimes they do, but most of the time they actually don't. So what the concept is, we as smart money traders, we wait for this to happen. So we draw this trend line as well, but we mark it as a liquidity zone that first needs to be cleared before we actually enter. So here we made it as liquidity, and our goal is to enter from the area over here where there's a break of structure. And again, what I've just said before about the premium and discount zones, we will do exactly the same thing over here, because we rather stay conservative than aggressive. All right, so here we have the break of structure, which generates the demand zone. All right, let's make it slightly bigger for the ID. And this is where our limit order will be on. So there we place our buy on the top of the order block, and we will target the high over here. So we have the swing low point over here and the swing high point here. So with premium and discount, you could mark it up like this, so you know that in this area are the places where you would like to buy, and we will go for the extreme order block. So we place our entry over here, and then we can throw it up all the way to the top side. So again, retail traders will enter on the third touch of the trend line, but we will wait until that trend line is being cleared by liquidity, and we will actually enter lower. The past events have shown us that the probability of these setups is way higher than just trading from trend lines. All right, here we have an example of the trend line liquidity concept on the 15-minute time frame. It's not the best example I could find. I was trying to search for my old trade that I took like a couple weeks ago, but I couldn't really find it anymore. That was before the new year. So basically what we have forming here is a little trend line. So here we have a high point. Here we have another high point, and this should have been the third high point. And as we can see, it actually broke through to our extreme supply zone over here. And this is where we want to enter from. Price just above the supply zone. And then we target the low over here. And that's it. That is basically the concept. So you just form a trend line. Above this area, there's liquidity that needs to be taken out first. And here we can see that happening. And then we see price to move further down again. So this is the whole idea behind the trend line liquidity. And here we have an example of an equal high. So here we have the lower low, lower high. Here we have a lower low. And here again a lower high, a lower low. And here's the equal high that I was talking about. So let's mark that up. From this area to this area over here. So there's liquidity laying above. And our plan is to enter from the premium zone here, since we are trading, or like from the premium, from the discount zone basically over here. So we place our entry just above on the low of the order block, stops just above here, and we target the low. And of course we can trail down even further, but for the example we put it over here. So this equal high needs to be taken out. There it goes. And are we going to get triggered? Yes, there we're getting triggered. And now it's time for price to move further down. And here you can see as well, supply zone formed, also got wicked by the candle over here, so price will go further down. So this is the equal high, equal low concept that you could also consider trading. And of course, we always like to enter from the premium and discount zones. It depends if we're selling or buying. Hopefully this makes things a bit clearer. And I'm using our own indicator, the smart money indicator. I'm gonna put this a bit higher and we'll remove the order blocks over here. And yeah, guys, hopefully this makes things clear. And yeah, it's important to remember that smart money concepts are just a tool. It's just like a trader's toolkit. It's always a good idea to use a combination of technical and fundamental analysis. So also think about news events that are coming up before you enter a trade. And it's also important to have a proper risk management to make the right informed trades. Now that you have a better understanding of the smart money concepts and the liquidity and inducements that's laying behind it, you can start incorporating them into your own trading strategy. As always, it's important to do your own research and remember to never risk more than you can afford to lose. Thanks for watching and happy trading, guys. See you next video.